Right, great. Hello, everyone. Welcome to Tax Laws 101 with CA Sarthak Ahuja, sir. Before starting the session, I think it would be a great failure on our part if we don't address the current situation in India vis-a-vis the COVID-19 pandemic. On behalf of all of us, our prayers go out to those who lost their loved ones, and a major props goes out to all the frontline and ground workers who've been working tirelessly to fight this virus and allowing all of us to stay at home and stay away from this harrowing virus. On behalf of the entire team at core team at Lex Macula, we encourage all of the viewers to follow all guidelines, curfews, and we're sure that we'll be able to pass through this rather difficult phase quickly. Now, coming back to the session, it's my great pleasure to give an introduction to CA Sarthak Ahuja, sir. I've been given a brief task of giving his introduction in a few minutes, which I don't really think is possible, but I will try and hit up the key highlights in his already lustrous career at such a young age. In 2017, Sir won the Indian School of Business's Young Leader Award and also was a gold medalist at the ISB. Sir was reported as the youngest Indian to complete courses in CA, CS, and CMA by the Financial Express, the Business Standard, and other national dailies. He also has an undergraduate degree in finance from the Delhi University. His expertise lie in this area of indirect tax, primarily the goods and services tax, for which he's been selected by the Institute of Chartered Accountants in November 2017 as one among only 48 professionals from India to be a faculty on the GST. Now, for all of you startup buffs out there, I know there are quite a few law students and even entrepreneurs in the audience. Sir has also been consulting with a lot of startups and working with virtual CFOs to help them manage their taxation. And I think everyone understands what an important step that is for the success of any startup, both nationally and internationally. He is a regular speaker on various topics relating to taxation at the Institute of Company Secretaries of India, Amity Law School, American Express India, and among many, many more illustrious institutions. To give the virtual platform to Sarthak Ahuja, sir. Sir, you may begin. Thank you so much for being here.
Thanks so much, Saharsh. That was a very generous, very, very kind introduction to all of you now present. So I think when I got that invite from Lex Macula, I was quite confused about what is it that they would want me to cover in tax laws, because this is such a vast and wide subject, ranging from, say, indirect taxes, where we speak of GST, which used to be, say, the excise, the custom law, VAT, which used to vary for every state in India, to direct taxes, where we have the income tax now, but of course, at one point, we also had the wealth tax and the gift tax and other such taxes which have been abolished. Over the years, of course, the government of India, as well as governments across the world, are trying to move towards a more unified tax law, which is constituted in every country, which is easier to understand, easier to examine, easier to implement in the country to collect revenues, while, of course, also taking into account all social measures that they need to take, social issues that all governments need to address, ensuring that those social objectives are met through the modus operandi of the tax laws. So while, of course, all governments try to converge to a simplified tax law, where we stand right now in India is a very complex set of provisions. And if we speak of international taxation, which is an even more complicated topic to speak on. Why so? So international taxation is not necessarily tax internationally. When we speak of international tax in India, it's taxation of international transactions in India. So, how the Indian income tax would interpret it. And if you've been following the news, you know of what has been happening with Amazon and a bunch of other startups and, big tech companies who operate globally. But when it comes to, doing their structuring of their multinational organizations, where, say, they have one head office in Ireland, another entity in Singapore, another pass-through entity in Mauritius, These structures are made by these international companies across the world with the objective of planning their taxes, optimizing on tax costs. However, it so happens that the interpretation that the revenue um, offers to or how there are retrospective amendments trying to bring all these novel, new, dynamic digital transactions into the purview of the tax laws. And wherever we've seen previously how even if the matter is settled by the Supreme Court in favor of the assessee, in the following Finance Act, the government is going to quite conveniently just change the tax law and ensure that those changes are brought about to be able to tax all such transactions in the future. So it's fairly evolving more so in the light of the fact that the ways of doing business is changing drastically and at a very, very rapid pace. So what I wanted to understand from the platform, of course, today is what is the need of our audience today. I'd be happy to touch upon the basics of the tax law, which I can understand from the topic, which is Tax Laws 101. While, of course, if you think there are more practical tax law practice oriented questions that you'd want me to answer, I'm happy to do that as well.
Right. Just seeing the response of the audience and even the response in the forms that we got. So, a primary question, I think, as a bedrock to this session, if you could just give an overview of the general setup in India of tax laws, a few legislations that are there, and how do they function. Then perhaps we can move more to the questions of practice and a career in tax law, practicing tax law, and even more practical intricacies. I think that's a good place to start. Then we can.
Absolutely. So I think, as I mentioned, there are primarily two ways in which a government taxes its subjects. One is through indirect taxes, the other is through direct taxes. Now, indirect taxes are those such as, and I'm going to give an example. Let's start with direct taxes then, for the sake of understanding. Direct taxes are those where it is paid by the person on whom it is levied. Looking at income tax, so it is directly linked, correlated, and proportionate to the income that you earn during the financial year. So if you've earned an income, you pay tax to the government basis the income that you've earned. You're the one earning it, you're the one paying it. It's a direct tax levied on you. However, indirect taxes are those which are levied on goods and services and are not correlated to income as such. So there could be a person, a pack of Parle-G biscuits, which is possibly the cheapest form of carbohydrate intake that you can get in the market, by a person who earns 50 lakh in a financial year, or by a person who earns just about say 10 or 15,000 per month. The tax or the GST collection on the consumption of that good or service is equally paid by people regardless of their incomes. So that is indirect taxation. Speak on the subject of direct tax for now. Act 1961 and the rules thereof. So, going by the understanding that we only have we have law students here who don't have much of a background on tax laws. The Income Tax Act 1961 aims to tax all kinds of income that an entity or an assessee or a person can earn. A person would include not just an individual, but a Hindu undivided family, also known as an HUF. It would include a partnership firm, an LLP, a company, be it private limited, OPC, or public. So any entity, be it trust, society, which earns anything which is classified as an income is taxed by the Income Tax Act. Now, what are these various heads in which incomes are classified? So there's income from house property. If you earn rental incomes, those get covered under income from house property. How is it taxed? So if you're earning income from a house property, it could be residential or commercial. Say you received 1 lakh as rent. The entire 1 lakh is not subject to tax. The income tax law, the provisions of the law, provide that 30% of a standard deduction is allowed on that income, which essentially means that on that 1 lakh, 30,000 would be deducted and only 70,000 would be taxed. Why is it so? Because the law also recognizes that the landlord is not just earning out of it, but also expending an amount to maintain that property. However, it would be a very uh, extensive and expensive exercise to be able to value what is the actual cost incurred on maintaining the property, which is why a standard deduction of 30,000 is given. You may be spending zero, or you may be spending a lakh and saving nothing at all, but you give a deduction of 30%, and the 70% of it is taxed as per the applicable tax rates on the person who's earning that income. Of course, if you have a housing loan against that property, the interest that you pay is also allowed as a deduction. This is giving a gist of what is income under house property. Now, moving on to the head of income taxed under the head salaries. Now, most people who end up paying taxes in the country right now, you see people in employment are covered under this particular head of income, where they have an employer who pays them a salary, issues them a Form 16, which is a TDS certificate or a salary certificate towards the end of the financial year, which would essentially give a detailed breakup of what is the taxable income that the person has earned through employment during the year, the various deductions thereon, and the TDS deducted by the employer. That TDS is calculated based on the tax laws. Now, what kind of perquisites also make part of income from salaries? It's not just the basic salary that your employer gives you. Your employer may also be giving you a house rent allowance known as an HRA, the entire amount of which may not necessarily be taxable. So you would say that there are certain exemptions or deductions for HRA available to various persons. Now there is a calculation methodology for it depending on how much rent you pay on a monthly basis. How much is your HRA component as part of your total package? So there are certain deductions for HRA. Now, of course, if your employer gives you gifts which are beyond the value of 50,000 in a financial year, that is also taxed in your hands. Um, so certain benefits, like if for certain people they get a car, which is a perquisite given by the office owing to the position of the person. So there is a calculation methodology and a formula given for almost all perquisites that you can think of to be able to define what is the value attributable to that car. So, for example, you've just gotten a car, but you don't know how to attribute that value. The income tax law, there are relevant sections which gives you a formula. For example, if the car has an engine of these many cc, or if the original cost was such, and you as an employee have paid certain amount towards the cost, then this is the value which would be added. Or there would be another mechanism given. So, the law is quite exhaustive to be able to give you methods to apply it. Of course, how people try to plan their taxes in such a way to be able to avoid it and claim it as a reimbursement, stating that this is not a perquisite, this is an expense for business, is what tax planning is all about. So, I'm digressing for a bit, but there are topics such as tax avoidance, there is tax planning, and there is tax evasion. Tax planning is considered absolutely legal and lawful, where you can, looking at the laws and the provisions of the laws and the deductions offered, intelligently preempt and plan structures around your transaction in such a manner that you optimize your tax costs to the bare minimum. Tax avoidance is possibly trying to ignore certain provisions which may be unlawful in practice to be able to save taxes, where if you are caught, you would be aware that there's a possibility that you may actually be some interest may be charged, or some penalties may be imposed. For example, if you've earned incomes in a foreign country, however you're a resident of India, and you choose not to declare those incomes to the Indian government, that could be tax avoidance, that could be tax evasion. You could say I've paid tax on it in a foreign country. However, for you, the mechanism available under the Income Tax Act to be able to take credit under Section 90 and 91, it may so happen that there is no tax liability eventually. However, the possibility of even say a 2% or a 5% tax liability after rebate, and you deciding not to disclose it, would amount to tax avoidance. Tax evasion is, of course, just going completely against the law and not disclosing something, outrightly refusing to accept, engaging in unlawful activities, not accepting something through banking channels, or earning money, keeping it in cash and not disclosing it, would be tax evasion. So that's a general brief. We were also on the topic of the various heads of income. So we've touched on house property, we've touched on salaries. Another head of income is capital gains. So whenever you sell an asset, um, which could be a long-term asset or a short-term asset. Long-term assets, a general understanding, are those which you've held in your possession for over 36 months. Short-term assets are those which you've held for lesser than that amount. However, when you speak in terms of financial assets, certain financial assets like shares and securities, if you've held them for a period over 12 months, they're categorized as long-term, and held them for less than 12 months and you sell them, it is categorized as a short-term capital gain or loss. Now, in long-term capital gain, of course, there is also this concept of indexation, which means that if 10 years ago or 20 years ago, you purchased a house property for 20 lakh, and today you sell it for 1 crore. Does that mean that 1 crore minus 20 lakh, 80 lakh is going to be your long-term capital gain today, which you're going to pay tax on? Not really, because the law also recognizes that over the years, there has been inflation in the country. The value of that asset today, or the value of your gain, is not necessarily 80 lakh. So comes in the concept of an indexed cost of acquisition. Your cost of acquisition of 20 lakh is subject to an indexation. The indexation chart is also disclosed or released by the income tax department on an annual basis. So it may so happen that you realize that the indexed cost is now coming to 3 times. So what I purchased 20 years ago for 20 lakhs, after putting the indexation formula, the cost of acquisition indexed is coming to 60 lakh, and today I'm selling it for 1 crore. That means my taxable capital gain is only 40 lakhs. Now, the law also gives you certain options of being able to save this amount and not put this to tax lawfully. How is it? If I'm selling a residential house property, but in return also purchasing another residential house property. So, which means I'm just upgrading my house, to a better location or a better property. It may so happen that if I'm upgrading or changing my house, even if it's for some other cause which may be more distressful than really, in that cases, I would of course need money to be able to move my house, which is why the law also says that if you're selling a house property and buying another residential house property, investing that sum at another place, it would reduce your capital gain, and the capital gain may actually come to zero. Similarly, for certain other sections, allow for other deductions. For example, if you sell a long-term capital asset, but you plan on purchasing, industrial land to set up an industry at in one of the northeast states or some other states or geographies in India which are recognized to be backward, the government, through its various deduction sections and mechanisms, would offer you a tax break or deduction because you're actually helping the government achieve its social objective of uplifting certain other areas. Which is why, as I mentioned, as a matter of good public policy, it is essential that people who are trained in drafting tax laws at the helm in every country are also aware and well educated in public policy, because it's one of the best tools available by the government to achieve its social objectives. Now, of course, the fourth head of taxable income that we come to is gains from business and profession, where any kind of business that you do, and the profits that you make from that business, which is after setting off all expenses incurred to earn that profit, that amount is taxable. And of course, if you're a professional, the definition of professional is given in the income tax law. It covers 11 heads specifically. So a lawyer is a professional, a chartered accountant is a professional, as is an architect, a doctor, and certain other classifications are given. A reason why it is necessary to differentiate between business and profession is because of certain specific sections within the law, multiple of them, which aim to differentiate between how the incomes or the profits of a general business and a professional normally differ. Professional providing services, And there's a manufacturer to compare it with. A manufacturer sells a good for 1 lakh. 60,000 or 60% of it may actually be the material cost for him. Another 10% may be cost of labor put on it, which means 70,000. Another 10,000 may be overheads, which means 80,000. So his net profit may actually be only 20,000. However, for a professional, there's a high probability, and these sections are drafted after looking at data of millions of professionals who've been filing their returns over the years, looking at statistics in a country. They would realize that professionals at max would have, say, 30% or 40% or 50% of their total receipt as expenses. If there's a practicing doctor, he's not selling a good. If he's charging for his time, there is a possibility that that particular service has a higher margin. So how there is also this wonderful Income Tax Act, which is about presumptive income. Now it says that if your turnover or gross receipts in a financial year do not cross 2 crore rupees, yeah, do not cross 2 crore rupees, and you can disclose minimum 8%, for example, very simplistically speaking, 8% of your gross receipts as taxable profits and pay tax on it, and the government would not ask you for detail of expenses. However, if you're a professional earning less than 50 lakh, or your gross receipts are less than 50 lakh in a financial year, if you disclose 50% of it as your taxable profit, the government is not going to ask you for detail of expenses. So, how this drafting is done, it again goes to show that certain sections are aimed at simplifying the work will while computing their taxes, so that they don't have to go through the hassle of maintaining all details of expenses, doing a thorough computation, getting it audited from a chartered accountant, which is why there are turnover thresholds and there are some such formulae defined in the law. That was about business and profession. One good example to give about difference between the income taxable from salaries and from business and profession is that if an employee, and you would notice people who after about 15, 20, 25 years of experience, when they are at the top management, a lot of times there is a possibility they may decide to not be on roll as an employee, but be on roll with the company as a consultant. The reason for that is they may feel that as a consultant, one, I'm not bound to one organization. It will give me the freedom to be able to undertake assignments with multiple companies who can offer to pay for my service. However, from a tax planning perspective, as a consultant, they will be able to claim expenses such as expense incurred on their car maintenance, or power and fuel, or diesel for their car, or part electricity expenses. If they've designated one room in their house as their office, then part electricity expenses for a housekeeper, stationery, and reduce their taxable profit. I'm not saying that's unlawful, but that would fall under the purview of tax planning if done well. Of course, there are people who could stretch it by every imagination and book every kind of possible personal expense to reduce taxable profits. That, of course, would be tax avoidance. So that's a decision a lot of people who have substantial salaries uh, tend to take, whether they want to move to the role of a consultant. Speaking of the fifth head of uh, taxable income, which is income from other sources. So whatever is not covered in the previous four gets covered in income from other sources. A great example to use here would be, say, income from cryptocurrencies. Now, a lot of people in the past 2-3 years have made money through crypto. Even when people come to me and they say, I've earned these many lakhs by selling the crypto that I had, or one, if you haven't sold it, it's just a notional profit. You put in 1 lakh, there's a possibility today you think it's worth 50 lakhs. Tomorrow it may come down and it may just be 25 lakhs. So till the time you don't sell it and book your profit, it is not a taxable profit. So the government is not out there to charge you on a notional income. Where is it though that a notional income does get taxed is if a person has multiple residential house properties. So the government says if you are living in one, whatever other residential house properties that you haven't rented out and you're not earning rent out of will be assumed to be self occupied, and you would have to pay tax on deemed rental that you would be getting if you were to let it out. That's a place where the government again is trying to achieve the objective of not having inventory left which is not available to house the masses. So that's one place where notional incomes are taxed. However, coming back to the topic of cryptocurrencies now, so if a person has sold crypto and says, I've held this for over 3 years, it is a long term asset. That person, in consultation with their tax advisor, tax lawyer, or chartered accountant, can choose to disclose it as a capital gain, long term or short term, and take and put it under that head. Another way to do it is if a person actively trades in cryptocurrency as their full-time profession, and that's where they earn money from. There is a possibility that your tax lawyer may advise, depending on the context of the transactions and the nature of your transactions, that this should be classified under business and profession and be taxed accordingly. However, for anyone who's randomly engaging in it as entertainment, as gambling, just to see how much money they can make off of it, a safe example would be to put it under the head of other sources. Where it's other sources, you just put in one line item. You don't have to give a detail of where you've earned this money from, and you can just disclose that amount and pay tax on it. One closing comment on this head of various heads of taxation, I would say, is that even unlawful income or undisclosed income. So, if you've earned money out of extortion or any kind of illegal activity, um, is subject to tax. So, the Income Tax Act says if you've earned an income, the legality of which we let the other laws take care of. But if you've earned an income, please pay your tax on it. So, I hope Saharsh and the audience that helps give a brief on where our tax laws are headed.
Right. Thank you so much for that. I think I'll push the conversation into a direction. I'm picking up a few themes from your initial introduction to just the structure of tax laws, and that was quite. As someone who's simply a novice in the field of tax, I now have an understanding of how things are taxed. A couple of years back, I think it was exactly 2 budgets ago, that securities like mutual funds started getting taxed, both long term and short term, at 15 and 10%. Combine that part with the general social narrative or financial narrative of there needs to be more investment in primary and secondary markets, with the theme of public policy, where investment in these leads to infrastructure development and so on and so forth. How do you see that avenue growing? Do you think that move was correct for the time? Was it a bit too late, or maybe should it have come maybe even 15 or 20 years down the line, after we had crossed certain development points in India, at least?
Great question. So how I like to address is it, you will realize that what the government does at any point where they realize that there is a huge tax potential in an avenue, which so far was untapped because the number of transactions weren't as many. And they try and iterate and try to fix a formula to figure out if they were to tax this transaction, how much more money can they make out of it? And while, of course, my political views I would not bring to the table at this point because that's not part of the discussion. However, that aside, quite objectively speaking, you have to see that a government also has a P&L, which it discusses during the budget. So, if of course they need to tax or they need to spend money uh, to for growth or to fuel growth in industry to alleviate poverty, they will also have to find out as problems increase. So even with the pandemic, as problems have increased, which would require the government to step in and spend money in certain areas, they would also simultaneously have to look at novel ways or avenues to tax. Now, one change that happened very recently, it's as recent as a few months ago, was that the return that people get on their provident fund is great in comparison to what they get from FTs. It was roughly about 8.59%, which you're otherwise not getting in your fixed deposits, which is why a lot of people who had a huge amount of money, people earning great salaries, um, they were trying to park their savings in PF only to be able to milk that tax free return from the government scheme. So the government said that if your earning from PF interest in a year exceeds 2.5 lakhs, it will not be tax free for you. So you see, the government also has a tricky balance to make, to be able to bring out policies which can also identify people who have a lot of money and they can be taxed within the same transaction, which is where thresholds help. Now, coming back to, say, mutual funds, another angle I would want you to examine or see is that government bonds or government securities are normally seen to be those which are very risk free, because they're risk free in comparison to investing in equities and mutual funds, which are, of course, prone to more risk. The returns in equities is also seen to be higher in comparison to these securities. The government realized that while there is a provident fund to take care of the retirement fund of people, they had to also change with the times and make an investment option regulated by the government, but at the same time be investing in equities and such avenues for the people to build their retirement fund. So they came out with the National Pension Scheme. Now, what is the National Pension Scheme? A lot of people invest in equity linked saving schemes for their 80C tax deduction, and just out of wanting to invest surplus money, invest in equities or mutual funds. But National Pension Scheme is where a person can decide to spend money, put it in the NPS fund. Now, in the NPS fund, they can decide how much percentage would they want to be allocated to government securities, to corporate bonds, to equities, to alternate investment funds. They can choose their mutual fund manager. So through the NPS portal, which is a government portal, they can choose whether they would want the ICICI portfolio manager to manage it, or the Kotak Bank or the HDFC Bank portfolio manager to manage it, and also max out their contribution into equity. So say if the fund allows you to invest 65% of your contribution into equities, a person can decide to do that. And their NPS contribution will then grow in that manner, congruent to where they're putting in their money. And at the age of 60 or 65, where they will be able to withdraw part of it as lump sum deposit and get the rest of it, which is left, as a monthly pension. So you would realize that because the government realized that only investing in risk free government securities may not really be the flavor of the market, and by investing in NPS, there's a better way of taking the surplus savings from the hands of individual investors and putting it into the industry, also giving them better returns from a retirement fund perspective, because inflation rates have seen to be greater than the rates that you get on your FTs. So how do you battle that? That again is a public policy matter. So I wouldn't say whether it's right or wrong for the government to tax mutual funds. If it helps them make money, and on the other side, if they spend it in the right direction, then of course it's probably worth it. It's going to pinch some, but if it benefits the greater good, why not?
Right. Thank you so much for that. I think a logical next step, I think just building on a lot of what the government decides through budgets. In the same budget, as I mentioned, mutual funds start to get taxed. The income tax bracket started including deductions for things like health insurance, which was obviously a move towards having people invest more in health insurance, because it's not something, yes, most of us do it, yet there is a significant percentage of people who don't have health insurance in India still, because perhaps asymmetry of awareness, which the pandemic has actually shown to be quite devastating. So, in the long term, of course, we're not getting to a government-based health insurance system like socialist countries do anytime soon. But how do you see those reductions in the long term? Do you think people will choose to opt for that and then pay tax at a lower rate, or maybe not opt for that and pay tax at a higher rate rather, and not opt for that and perhaps pay it at a lower rate?
See, so with respect to, say, health insurances, the government under Section 80D says that your contribution towards purchasing a health insurance up to 25,000 is deductible from your taxable income to save taxes. Now, if you also contributed for your parents, that deduction is available up to 30,000. If you contributed for your children or your spouse, you get an additional 25,000. So there's a possibility that a person can contribute and purchase health insurance for their family and get that additional tax deduction, which may not be limited to 25,000, but maybe say 50,000, 25 plus 25, say paid for parents who are not senior citizens yet. Now, think of it. The government is not actually telling you to purchase insurance from the General Insurance Corporation of India, or um, or say the LIC. The LIC doesn't do general insurance, but of course, speaking of, the government is not mandating that you buy it only from this entity. You are free to go to the free market and purchase it from ICICI Lombard or any other insurance provider of your liking, where you think the scheme is good, uh, fits your budget, gives you the maximum return for your money. So the objective here is not to get money to a particular end. However, they do realize that a lot of times, that's how human psychology works. You would think, or people would tend to think, that health insurance, I am fit, I am young, I may not need it. Why should I pay 25, 30,000 on an annual basis when there's a high chance I may not really be incurring or needing any medical care for the next 10 years? I'm 20, nothing's going to happen to me in the next 10 years. But fortunately or unfortunately, life is such, you never know when such requirements may come about, which is why, again, it's a public policy matter of incentivizing people to at least invest in this. So, that's one objective. Apart from that, there is Section 80 of the Income Tax Act. There is Section 80U of the Income Tax Act, where if you spend on a dependent disabled in your family, which could be a parent, it could be your spouse, it could be your children, or if you're someone who's disabled yourself, which gets covered under 80U, there's a deduction of 75,000 or 1,25,000, depending on the degree of the disability that is available to you. So you don't necessarily need to spend money thing. However, what you do need is a certificate from the doctor certifying that yes, you are disabled to this degree. So, even that is a social motive that the government is trying to achieve through this. I hope that answers.
Yeah, definitely. I think I'll now circle back to a theme you mentioned in the initial introduction, how a lot of senior employees, they choose to work as consultants, which sort of comes under the broad term that we call freelancers, but which has become popular due to the pandemic, of course, wherein they can write off a lot of expenses. So I think this is something that a lot of our audience members must be going through, that people who have just started off becoming freelancers, artists, musicians, and whatnot, how do they go about their taxation? Because of course they don't have a very conventional sort of business. They're not sure what to write off, what not to write off, and yet they do want to save as much as they can from a tax planning point of view. So what do you think should be the first thing that they do in towards, they earn, let's say, 5 or 7 lakhs a year, which prior to people working from home wasn't possible. So what's your take?
Right. So, in terms of first steps, I'm assuming this question has been asked from the perspective of very young people, freshers, or just getting into the job market or freelancing market and have just started earning money. First thing is to understand the tax brackets. So, there is the old tax regime and there's a new tax regime. So, as per the old tax regime, which is continuing, of course, so there are two schemes of tax rates by the government. Up to 2.5 lakh of your incomes in a year, there is 0% tax. 2.5 lakh to 5 lakh, there is a 5% tax. 5 lakh to 10 lakh is a 20%. Above 10 lakh is a 30% tax rate. Over and above this, there is, of course, health and education cess of 4%, which is applicable on the tax. The new tax regime, but within the old tax regime, you're allowed various deductions, such as making deductions under Section 80C for purchasing life insurance, for purchasing medical insurance under 80D, health, um, house rent allowance, making all these deductions are allowed. However, as per the new tax regime, what they say is they're going to subject you to lower tax rates for each of these slabs. However, at the same time, we're going to remove all tax deductions which are available. So all those deductions would not be available, which means, say, for a 5 lakh income, there would be a 10% tax rate. Now, 5 to 7.5 of your income is taxed at, say, 12.5 percent. Now, if 7.5 to um, 7.5 to 10 lakh would be taxed at, say, 15%. So there are, with increments of 5% at every increment of 2.5 lakhs is how the new tax regime is structured. So if you understand that your earning through the year is within 5 lakh, you are anyway not subject to tax. However, optimistically speaking, people are earning more than that. It may make sense for them to follow this basic thumb rule, which is, what is the nexus of this expense? That is, the nexus justified for business? If I've made this spend, does it justify as a business expense? It's something I recently spoke about on my Instagram file as well as on my LinkedIn, about how even expenses that you incur on pets may be allowed as deductible for the purpose of business, from the perspective that if you have a facility where you stock goods, if you're a trader in goods and you have a dog which rids that place of rodents, so if you spend money on maintenance of that dog which has some purpose for your business, or if there's a dog watchdog that is um, you know protecting your business premises or offers those kind of services, and if you spend on maintaining that dog, that expense may be allowed as a business expense. So it's all about whether you can justify it for business. When I also spoke about the presumptive tax scheme, that also gives a general thumb rule understanding of that if you're a professional and you're not earning more than 50 lakhs in a year, you possibly don't need to bother too much about which bracket of expense I'm spending money at. If you show a minimum of 50% of that as taxable profit, um, that would fly with the government in huge probability. Similarly, if you are engaging in another business, which is dealing in goods in some form, and you show minimum 8% profit, um, that would fly with the government. So just follow the basic idea that it has to, from a common sense perspective, you should be able to justify that expense as incurred for business.
Right. Thank you so much, sir. So, just a general rule of thumb: if it has nexus with your business and you can justify it, I think you can it off. So, I think we've gotten a lot because of your introduction. We've got a lot of questions on cryptocurrency. I'll try and sort of club them all together. Otherwise, I think we'll be sitting here till 9 o'clock just talking about crypto. But of course, why not? So, first off, I think is a general question that perhaps even right from people who are 15 years old to people who are 55 years old ask, is it first of all safe to invest in cryptocurrency there as a prudent investor? Then comes in the question of, is it legal, or because it's not at this point in time regulated by any umbrella body, so to say, because other securities which don't have actualized value unless it's traded have regulatory bodies. Crypto doesn't have that yet. So how do you see its legal status, simply from a tax law point of view, of course, and then of course the viability of investing in something like crypto?
Okay, so two aspects here: legality and whether it makes for a good investment. So, quite honestly, I think legality, speaking of legality, because that's simpler to answer, as of now, crypto is not illegal in India. However, the RBI has on multiple occasions issued advisories recommending people to not invest in it. Plus, the RBI governor has also gone on record multiple times stating that the RBI is working very hard and very fast towards developing an own version of a cryptocurrency, which will be considered as legal tender in India. So that's one part about the legality. Even if it so comes a point in a few months where the government may say that all these cryptocurrencies, other than the one which is regulated by the RBI, whether regulation is possible or not in crypto and to what degree by a central bank, that discussion aside, if they say that all other cryptocurrency barring this are banned or not allowed, I'm sure it would make prudent sense from a public policy perspective to also give about 1 month, 2 months time for people to liquidate that amount and phase it out. However, what might also happen, because you realize when people make investments, there are several ways in which people make investments who've got surplus money. A rational way of making investment would be understanding what does the asset derive its value from. So when you are investing in equities of a company, what you try to do is fundamental analysis. You try to go through their balance sheet, financial statements, you try to read their director's report, you try and get an understanding of how talented or perseverant or how dynamic is the management of this company. Do they have a long term vision? Are they making changes to grow this company in line with how technology and business is growing? So you're basically betting on the people running the company. You're betting on the ideas of the top management, the directors, and you see value in what the business is doing and how much profit it's generating year on year. So the possibility of them offering dividends or the price of the share increasing, those are things that you try and analyze from the financial statements, which is backed by the actual business performance of making sales in the market and generating profit. Now, of course, there is a possibility that, God forbid, a person from the leadership passes away tomorrow, which is going to bring the value of the equity down, owing to public sentiment on that day. If a lot of people were just betting on the leader to take it to the next level. However, when it comes to cryptocurrency, one, there are innumerable cryptocurrency. Of course, Bitcoin being the most popular name, but there is Ethereum, and then there is Dogecoin made popular as a joke by Elon Musk, and a bunch of others. So today, anyone can launch an ICO, which is an initial coin offering, artificially, do multiple trades with a bunch of cartel of people, hike up the price. So I think a lot of, if you think of what is backing investing in cryptocurrency, it's basically investing in an idea which is backed by the blockchain technology. So, just my personal view, it makes better sense to invest in a product or a service or a company which is using blockchain to improve or disrupt an existing product or service in the market. When you're investing in cryptocurrency, it's almost like purchasing dollars from the perspective of expecting the dollar to rise in comparison to the rupee. So, there's nothing backing it apart from, say, a lot of the hype around whether this will grow or not. So, I would say this is more entertainment, where it's great if you have, say, if you have a well diversified portfolio where you've invested in all kinds of assets, those which are risk free, those which are more risky, you've invested in equities, and then just to play, to add to your investment portfolio, you should go ahead and why not invest in cryptocurrency if you want to. Just know that that cannot be your only avenue, because if you're doing that, then you're just gambling and doing it out of entertainment or the kick of having earned this much return. But of course, there's also a possibility of it going down tomorrow, some announcement from the government, and the value goes down. And see, eventually, when you invest in money, you need a way to be able to spend it. If the Indian government or multiple other governments across the world decide to ban a particular kind of cryptocurrency, you can only spend it in a few geographies for a few kind of product or service. The value for it may again go down, because if you want bread today, you can't go to the market and pay in Bitcoin and get it. So I hope that answers.
Yeah, thank you so much. And I think even though this answer may have not been as exciting for a lot of crypto enthusiasts, but I think it was very much needed because we never know what will happen maybe a month or two down the line, perhaps when the RBI issues what it's been a little issue for a long time. I think a next logical step that we can move towards is start taxation structures for startups, for new companies that have just come up. We've seen, I think, one silver lining, if we can see during the pandemic, is that a lot of new companies have started. A lot of majority of them working online. So, could you give us an understanding of how does taxation look from a startup's perspective? And a few things, if you could touch upon, is from what I can see in our comments, is first of all, like a lot of startups in the United States are registered in Delaware. Is there a similar structure for that in India or even Asia for that matter? Then, how are startups valued when they're at the nascent stages? And another sort of important question that's coming up is how do startups start to tax themselves when they initially make a profit, specifically if they're working all over the globe, as not exactly as MNCs, but they do have international clients.
Okay, bunch of questions here, all of which could be really long debates and conversations in themselves. But quickly touching on answering all of them. So, firstly, talking about taxation of startups in India, you would realize, as I mentioned, under the head of business and profession, it's only the profit that you make is taxed. So, for most startups, using investor funds to fund growth in the first few years, which essentially means that they're incurring heavy losses and not making any profits because all that money is being spent on salaries, acquisition through advertising, through funding downloads of apps, and getting people to use their product or service. By which logic you would see, let's say, the first 4 or 5 years of a startup are only going in funding and fueling growth, which means they're not making a profit. That means again that it's not taxable. However, if they've also filed their taxes in time, all the losses that they incur are available to be set off against the profits from the year in which they start making profits. Now, assume fifth year onwards, they start making profits, however minuscule, but the whole load of losses that they've accumulated till then will now start getting set off from their profits, and they may again not be subject to tax till the time the accumulated losses are set off against the profits, assuming that's done by year 7. Now, there's a wonderful section again in the Income Tax Act which gives a 3-year tax holiday to startups. What does it say? That if it's a startup within the first 10 years of its incorporation, if it begins to generate profits and having set off its losses, a startup can choose any 3 years within the first 10 years, any 3 consecutive years when it can take this tax holiday. Logically, a startup would only do it if, say, in the first 5 years, as an example, they've incurred a loss. In year 6 and 7, they've made profits, but set off all those profits against carried forward losses to save on taxes. And for the year 8, 9, 10, they could take that tax holiday. So that's one wonderful section available in the Income Tax Act to help and assist startups. For that, of course, the procedure is they need to be registered on Startup India, but that's not it because that's a very easy registration. They need to also get a certification from the Interministerial Board, which is directors from 3 government boards sitting together and evaluating the pitch of the startup as to what kind of business model they have, whether it has the potential to disrupt the market with technology, hugely improve on a process or good, has huge potential for wealth generation or employment generation. If your business model can justify that, they may give you that benefit of a 3-year tax holiday that the startup can take. That's talking about startups in India. Another tax take a huge amount of time again in this the United States, you'd be aware that there are federal taxes and there are state taxes on all persons. State taxes are imposed of subjects of a particular state. However, in the United States, there is a state of Delaware, which is focused for very many years now. So it's not a new phenomenon. It's something which started many years ago, maybe sometime in that Delaware decided they wanted to focus all their revenues on being able to earn money from registering in Delaware. One Bill 02, I'm probably skipping it. It is the registered Amazon, Pepsi, Coke, the biggest multinational enterprises are all registered in this very modest looking building in Delaware. The reason for that is the concept of a tax haven, as they call it internationally. So what happens in Delaware is that if you are registered in the state of Delaware, however, you do not operate your business in that state, you operate in some other state. The state taxes are not levied onto you. Okay, the state taxes are levied only in the state in which you operate. Now, what happens? Registered, say, in Delaware and are operating in California. So, what they do in California, they will book an expense of a franchise fee. Delaware entity. That franchise fee would be marked as an expense and reduce the taxable profit subject to state tax and increase the taxable profit through franchisee fee or royalty in Delaware. Now, in Delaware, that franchisee fee will not be taxed as per tax rates. It will be taxed at a separate tax rate called the franchisee tax, which for a company in its business model may turn out to be substantially lower than what it would be to pay state taxes, which is why you would notice that most multinational corporations in the US or startups looking for funding, looking for IPO with ambitions of high growth and international appeal, prefer to register in Delaware. Delaware, of course, with all these companies registered there, its legal structure is also such that there is a judge deciding on matters and not a jury, as is the case with other states in the US. So you know that you have someone who's studied the law, who's aware of business laws, giving a judgment, and not a jury, which may be of inexperienced people. At the same time, owing to the fact that so many companies are registered in Delaware, your Ubers of the world, your Googles of the world, all new age legal issues related to digital transactions or blockchain related transactions or new technologies or IP laws. Of case laws available in Delaware is so exhaustive that the resolution of the dispute is so much swifter in comparison. If we speak of a comparative geography in Asia, I would say Singapore is very popular with startups. Hong Kong is very popular with startups. But Singapore specifically, there are a bunch of startups in India operating in India who've chosen to register in Singapore. One, because of a lower tax rate. So in India, if the tax rate is about 25-30%, in Singapore, it's about 17% or 18%. Then the GST or the indirect tax or VAT as it's called in Singapore is a flat rate of 7% in comparison to being 5% to 28% in India. Also, a big reason is that in Singapore the capital gains tax is 0%. So a lot of the investors who are putting in money in startups choose to take the Singapore route because tomorrow when they're looking at their exit at a 10x return or a 20x return, that's going to be classified as a capital gain, and they will really optimize on the tax costs if they were registered in Singapore. The Indian Income Tax Act, of course, identified this in the Vodafone case of 2012, decided on by the Supreme Court, and then in the Finance Act, a new provision was brought about which said that if the asset or if the underlying asset is of the business is in India, then regardless of it being registered in Singapore or Malaysia or Mauritius or Hong Kong or wherever, if the underlying business which gives the entity its deriving value is in India, then the Indian tax revenue department would have the right to tax it in India as well. To a lot of litigation, not just in India, but even internationally. Matters have gone to arbitration in Singapore, have reached the International Court of Justice, where it's been decided against India. But of course, these matters, I'm not an expert at international tax matters, so I'd leave that for the experts.
Right. Thank you so much for that, sir. I think the next sort of theme of questions, and actually, to be honest, I'm really sorry. I have to club together a lot of questions, but since we're getting a lot of questions on similar themes, so I think it makes sense to just combine them. So the next sort of stream of questions that we're getting is based on, as tax attorneys, people working in tax laws. I think a major step is that a major complaint that's coming from a lot of law students is that what they're taught at law school is quite theoretical. They're taught basic income tax act and a couple more statutory provisions here and there, and that's about it. They don't really understand how tax attorneys function at, let's say the income tax tribunals and other tax law tribunals, and also how do they deal with income tax officers, and of course managing that alongside other uh, persons who deal with tax, such as CAs and company secretaries and so on and so forth.
Yeah, so I think a good analogy here would be that regardless of what kind of laws you're practicing in, be it taxes or non-taxes, I think it's very similar. Where if you study the law of contracts, but till the time you actually don't get down to contract in the court of law in front of judges, that you don't really get the flavor of deal with it, how to read it, how to maybe interpret facts in your favor. And a lot of times you would realize that there is not as much time you get in the tribunal in front of the judges to be able to present your case. It's almost like you have not more than 2 minutes, absolute crux of a 200-page submission, which you're anyway giving in writing. So it's only through experience and maybe working with the right kind of a mentor in the initial few years would give you that knack of understanding, okay, in those 2 minutes, I just need to touch on these two topics or say these four keywords, which will tilt the interpretation of the judges in my favor. So that's something that only practice will teach. And I think it's very, very similar for tax laws. What I do see though is that for a lot of law students, they feel that tax laws are a little more intimidating, and they tend to feel that it's probably the forte of chartered accountants. I would say that if a lawyer decides to get into tax laws, I personally feel they'll do so much better than what CAs can do, purely from the backing of the training they get in law school, the fact that they engage in moot court competitions and get exposure to actually going to the court much more than chartered accountants go to, which is why I would urge that it's a very profitable, great field to look at in addition to corporate taxes for budding lawyers.
Right. Thank you so much, sir. Hello.
Yeah, I can hear you.
Hello. Yeah. Yeah. Great. I think there was a slight network lag at my end. Sorry about that. So. Next, a rather very interesting question that's coming up is we've all, I think the Indian Premier League is on, and most of us are glued to that, watching that post 7:38ish in the night. So we've been seeing a lot of ads for Dream 11 and a lot of other fantasy games. How is the taxation of those work out with vis-a-vis if someone does win and make profits of that?
Yeah. So, uh, interestingly, games there is a provision under the Income Tax Act which says that Under the head of business and profession, there's also the head of speculative business. So if one were to say that it is their full-time business to engage in speculation on different platforms, be it from the platform of cryptocurrencies or intraday trading in high volatility securities or horse racing, um, or any kind of gambling, legality aside, all of that can be disclosed there. If nothing, if it's just a side hustle that people do for entertainment, any winnings from it, net of all winnings, will anyway come to you after reduction of 30% TDS. So there's a possibility that your um, actual winning may be a lakh, which is a huge amount. Say, conservatively speaking, it's if you've made a winning of 10,000, you will actually receive only 7,000 in your bank account after deduction of TDS, and such incomes may be subject to the highest tax slab rate, regardless of your actual tax rate on that.
The next question that's coming up is recently in the 2021 budget, our finance minister talked about a digital census being taken for the first time, perhaps ever in this part of the world at least. So, how do you see that from A, of course, a taxation and people trying to avoid tax point of view, and B, because realizing that that's of course going to be a challenge infrastructurally from a public policy point of view, because that does sort of come together in a certain way.
See, I think to make any policy, be it in your organization, even if you were to make a latecomers policy, you would first need data on how many people actually come late and by how much time, how much does it cost the enterprise in terms of late coming, in terms of lost hours converted to money. And then on the basis of such data, you come up with policies where you say that, okay, if you're late by this much amount, you will be fined X, or certain percentage would be deducted from your monthly payout. Now, similarly, I think census data is very important for any government to be able to determine taxability. What I think it would help is the government to get a better understanding of how much percentage of people are in which kind of geographies. Because income related data is something that they already get from tax filing. What they can do is basis geographical basis. If some data does not correlate to their findings on analysis of income tax returns, they could try and identify reasons for those gaps and bring out certain policies to be able to bring those gaps under the tax bracket. So I think the census is a huge amount of data collected for a country as expansive as India. One would need um, a highly experienced data analytics firm, or say a good coalition of multiple such global firms analyzing that data and coming out with proposals on how to do it. So I think it'll be a great learning opportunity for anyone who gets to do it and gets access to that data. That said, what is also essential is how that data is eventually presented. So someone else's lens of looking at the data would be, say, from the perspective of where all the money has to go. Another person's lens of looking at the data would be, where is it that I can extract more revenue from? The idea is to maintain a balance between them. Um, as all of us, I would assume, are proponents of better technology. I think if implemented well, if the IT infrastructure is good enough, a digital census, if has accounted for all practical problems of doing it digitally, where what is the digital penetration in India, if they can get more authentic real-time data in doing this digital census, it will really remove the lag that comes into play in the data collection and drafting of the policy and implementation, which may take 3 4 5 years. So if this digitization can give us more real-time data, I think it will be more beneficial from a tax planning perspective.
Right. So I think another question, which I think is quite popular in whenever the topics of tax comes up and investment comes up. Uh, since due to the pandemic, I think people have started to realize the importance of making investments for rainy days and making your money work for you. I think there's a question by Bhavya, as a matter of fact. He asks that what do people who've just started earning, just got their first jobs, or just out of college, where do they park their money to A, of course, tax as possible, and B, earn significantly more than, let's say, if their money was simply in a current account or a savings account?
Okay, so one, of course, thumb rule of investing is having a diversified portfolio. I would not say that you put everything in equities. It would be nice and prudent on your part to research more. It would be unfair for me to advise thumb rules here, not knowing of the earning capacity or having any data on the audience today. But what it would make sense for people to do is allocate, say, 20% to absolute risk free investments, like, say, a fixed deposit, attributing a small sum to a retirement fund from a long term perspective. More importantly, if it's people in there who've just started earning, there's a possibility that they may be saving for a higher education 3 to 4 years down the line, which means that your investment horizon is not very long to be able to see and go through a huge cycle in the equities market also. Which is why it might make sense. So, if your investment objective is to save for a higher education, you may want to park a slightly larger chunk towards a more risk-free, um, you know, asset or investment or a government bond. If, of course, you feel that there is no such foreseeable big expense coming your way in the next 10 years, it might make sense. If you're not supporting your family, if you're financially free and all of that you're earning is literally your saving, because you're also dependent on your family or your parents for other, menial everyday needs. In that case, you may have the liberty to invest it in, say, equities. There, if you have the time to track companies, study about various industries, study about companies, understand their balance sheets and their financial statements and documents, then I would say take a more active role by investing directly in equities. If you do not have the time or the inclination to do that, a mutual fund route may make better sense to you, because you're letting a professional fund manager take care of how to allocate your fund.
Right. Uh, I think a very interesting question has just come up in the chat. I'll just pull that up. And I think this has been in the news for the past 4 5 days, if I'm not mistaken. China has just announced that they're on track for announcing essentially a digital currency to challenge the dollar, or the might of the dollar as it is, where renminbi will be able to challenge that. You earlier on in the session, you talked about how maybe a few years down the line, there'll be a cryptocurrency backed by the RBI and regulated by the RBI. That would be perhaps the only cryptocurrency that will be allowed to circulate in India. Do you see this currency being similar to that, or because RBI, of course, works very differently than the Central Bank of China, wherein they fix or rather block the value of the renminbi from time to time. So, do you see us having a parallel of sorts, or maybe something completely different?
While this does not really pertain to tax laws, and I don't think I'm an expert at this, but again, just my 2 cents on my interest in the topic and my readings on how these economies and their public policies function, you would realize that over the years, for multiple policy making matters that impact the entire world, different countries come together and try and devising policies that all countries try and achieve. You could say that about sustainable development goals. You could say that about policies relating to carbon credits. you could say that about international tax laws, where now there are multilateral instruments coming about, which essentially means that as of now all countries have double tax avoidance agreements with each other. And India's agreement with US may be very different from India's agreement with Mauritius. Um, However, now with multilateral instruments, a central governing body is trying to define a template which is more holistic, which is more uniformly applicable, and getting different countries to sign off on them. So, the number of participating countries that keep agreeing to it, those pool of countries would then abide by a multilateral instrument to the extent that they've agreed on certain clauses vis a vis other countries. So what I do see is that cryptocurrency again will definitely at some point aim to become a global currency. So what might happen is, now again, because I'm unaware of the technology, so I don't know how much any central bank can regulate this and to what degree, and what is the tech or algorithm behind regulating any such currencies. It may so happen that certain groups of certain countries may come together to say that okay, we recognize this currency, and so India may join hands with say US and a Russia and a Japan and China and a few more. So wherever a few major countries come together and recognize certain cryptocurrencies, I think eventually the world will move towards a limited number which is accepted by major countries, and there may be some rules defining how information relating to that is to be shared between nations, and how much of it is to be accessible to nations under the law, where a person who's engaging in such transaction to be able to report it in his income tax return in different countries, and then the countries can pass on that information to the other country to see whether it's taxable there or not. So of course I think it's similar, but at this point it would be very difficult for me to say whether they will emulate the China currency or not. That could be definitely a starting point. So this is a iterative process. As India's constitution was also taken from a mix of different countries and put together, I think China could be thought of as a front runner in trying to develop this process. A few other countries will come up with their policies, and then we could just pick up and see what works the best, looking at the numbers and the data in India.
Right. I think this is probably the last sort of academic question, and I think I thought it'd be appropriate to just go full circle as the session. You started the session off with how tax law, there's a quest for having a unified global tax law. And but I'll to be honest, ask for I'll apologize in advance to you and the audience, because this is more of a philosophical bent to this question. That let's say if in an ideal world, and I know we don't live in an ideal world, of course, there was a possibility of having a unified tax structure, tax system, and considering that we do live with inequalities from developed countries to developing to underdeveloped to poor bankrupt countries and whatnot. And if we do get to that phase, do you not see our structures making the tax structure in the sense that it will only benefit the top upper echelons of countries, and the bottom countries would again be struggling?
So many different angles here. So one, I mean, if you talk about where business is going, because that's where the tax revenue is coming from. Um, Globally, if we speak of the abbreviation FANG, which is your Facebook, Google, Amazon, Netflix, Apple, all of these enterprises are bigger than countries put together, and their earnings are bigger than countries but put together. So globally, it may so happen that there could be, just thinking out loud, say 10 global companies in the world which are almost functioning like 10 countries, which primarily control the entire supply chain, the product chain, the manufacturing chain, the entire economy of the world. Those enterprises may become countries in themselves, in a notional, non geographic way. um, going purely by their global reach and how they touch every single point on the globe. Um, if you think of how every geography tries to protect um, itself while making revenues, the equalization levy in India is a great example to think about this. So it says that if a business is spending on online advertisement, for their business and making that payment to a foreign entity not registered in India. So, for example, if I were making spends on Google Ads and that invoice comes from Google Ireland and not Google India, I'm paying a foreign entity for a digital service of running ads online. If that spend is above 1 lakh in a financial year, then I am liable to pay 6% equalization levy to the Indian government as tax. Now, if you think about it, one, the equalization levy is a way to tax this kind of a digital transaction, while at the same time, they put that threshold of 1 lakh because they may realize a lot of small businesses may be coming online and spending money who we don't want to tax. We want to tax businesses who have so much money that they have a budget easily of 1 lakh per annum to be spending on one vendor globally outside of India for digital ads. It may so happen different countries may come up with their own version of equalization levy, and you know then even any kind of tax policy, as it is for other law policy, is developed by studying the tax laws of different countries. So again, it's going to be an iterative process. Um, Taxes have always been influenced, in my opinion, also by power, where corporations, the haves, people right at the top, will lobby with the government purely basis the the network that they have or the access to resources that they have, and be able to very strategically have the policy modified in such a manner that they end up saving huge amounts of taxes, and there is no hue and cry about it because since the common man is probably not impacted directly as an impact of it, one may not even realize what has happened behind the covers because it may be so macro for an individual person or a small business to be able to examine or even think about. So, of course, I think, again, as you mentioned, it's a philosophical question. But we definitely see, as we're speaking about cryptocurrencies, we're speaking about global currencies, speaking about global businesses, startups registering and looking at different geographies to register in, the world will definitely go towards a unified tax law.
Great. Thank you so much for that. I think a good closing note for this session is can be that a lot of people have talked about how they wish to go towards practices of tax law and helping startups, but it's from the outside very 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 daunting. And I think all of us viewers and even as the host here, I'm very grateful to have someone who's not only done all of that, but did that at such a young age that we can all look up to him. So if there's any one piece of parting advice on perhaps motivation, drive, and sort of not letting fear get the better of you when you're entering fields that are considered very technical or number driven, I think I can't think of a person better than you, sir, to motivate the students.
So, while again, not my forte, but I think two things to remember now. One, of course, is the concept of compounding. As they say, compound interest really grows your money. It's the eighth wonder of the world where you won't even realize how that money gets compounded and it'll generate exponential return, which you would not be able to mentally visualize without putting it down on paper and actually doing that calculation. I think that compounding works not just in money and investments, but also with respect to how much time you invest in gaining knowledge on a particular subject. So it may so happen that in the first year, the first few months, the second year, the third year, you may feel like there are miles to go before we sleep in getting an in-depth understanding on a particular topic. However, if you just keep at it, you won't even realize It's not an overnight thing, but that compounding of knowledge really adds up to a lot. So just it basically narrows down to perseverance. Just stay at it. You just need to stick to something, not get diverted by, oh, that guy made so much money in crypto, so maybe I should just remove my focus and put some amount of my time there. Of course, explore, be curious, get to know about everything, but also know about your sole primary focus and work on it with the concept of compounding. The second thing, a beautiful thing that I read in the Amazon Jeff Bezos's letter to shareholders in 2020 um, was that the coming decade is going to be the decade of content creators. As in the late 90s and the 2000s, it was about the websites and then the apps and aggregators and startups. The next decade is going to be for content creators. So always strive to create more than you consume. You can only leave a legacy, and you can only create when you're consuming enough to have that knowledge to be able to create. So always try to create more than you consume.
Right. Thank you so much, sir. On that note, I think let's bring this session to a close. Before going, I'd like to sincerely thank CA Sarthak Ahuja sir for being with us for the past hour and a half, pretty much now, and sparing his busy afternoon and evening with us on a Wednesday, and taking time out of his schedule. And even to all of the audience members who gave us this time, that things at home and even all around us may not be the best, but I think as Harry Potter, as I'll quote my favorite movie here, Harry Potter, where there's always light if you remember to turn on. I know I messed up that quote, but just stay hopeful and try and do as much as possible to help those around you. But of course, follow regulations, and yeah, hope to see you in another setting, probably in a better situation in the coming weeks. Thank you so much, and I think with this, let's end this session.